With US stock indexes priced to perfection, focus is on today's US inflation read and how it affects the mood and the next Federal Reserve monetary policy decision. As was expected, inflation in the US, that is change in the consumer price index, rose to 2.7% on a yearly basis in November from 2.6% in October. Hello and welcome to another episode of Global Business Insights, where we bring perspectives from seasoned experts and analysis diving deeper into the headlines. Technology is expected to feature in a big way in 2025 and the signs are already compelling. Alphabet stock was up after unveiling its new Willow chip that can perform a benchmark computation test in under 5 minutes compared to the 10 septillion years required for the current fastest supercomputers to complete. Alphabet stock added about $136 billion to its market valuation, seeing its best intraday gain since April. Oracle did not have as good a day as its shares had their steepest drop in a year after a disappointing earnings report with weaker than expected forecasts. Still, the stock is up about 69% in 2024, headed for its best year since 1999. Still on technology, analysts see a shift in advantage from AI infrastructure providers to software players. Database software company MongoDB and enterprise software company C3.ai were the latest to beat earnings expectations on the back of AI demand this week, following software provider Palantir Technologies. Unlike Oracle, which is investing heavily in building data centers to compete with Amazon, Google, Meta, and Microsoft, the more successful software players seem to be leveraging the infrastructure of the larger rivals rather than taking them on directly. In the US, stock indexes slipped lower for the second day yesterday as the focus shifted to today's inflation read. Shares of Walgreens soared 20% on a report that it is in the process of selling itself to private equity firm Sycamore Partners in a deal that could be completed early next year. Falling costs of money and market optimism could already be raising the appetite for deal making. The perception of a Trump government with a softer regulatory touch also suggests more deals likely to go through. President-elect Donald Trump has said he would expedite the approval of permits to anyone who invests $1 billion or more in the United States. Trump had campaigned on slashing regulations in order to stimulate economic growth. This is as Biden warns that a great economic legacy is about to be marred. Another theme to watch in 2025 is the trade and technology war between US and China. China recently responded to US measures by banning exports of critical minerals. Yesterday, Nvidia shares sank more than 3% after Chinese regulators announced investigations concerning Nvidia's acquisition of Mellanox, looking for possible violations of anti-monopoly law. Is Beijing using the threat of full assault on Nvidia as a bargaining chip, and who will be next? Yesterday evening, General Motors said it is restructuring Cruise, its self-driving taxi company, in what amounts to exit from the robotaxi business and a refocusing on basic driver assistance technologies. That leaves Alphabet, Waymo, and Tesla as the main players aggressively pursuing self-driving robotaxis in the US. We also conclude our clip with Tola, Adeyemi CEO KPMG on CEO hot buttons, especially in Africa. Governments play a significant role in 2025 and CEOs need to work better to influence and support governments to get the best business environment. The last leg in fighting inflation, they say, tends to be the toughest, and the focus was on today's release of November inflation figures in the US. That would be the last batch of data just ahead of the Federal Reserve's policy meeting next week. November US inflation rose from 2.6% to 2.7%. The data reflects the expected stickiness in inflation following a previous increase in October. On a monthly basis, prices were up 0.3%, and if you strip out food and energy prices, core CPI rose 0.3% for the month, or 3.3% on an annual basis, also as expected. Ahead of the reading, there was a sense of zigzag inflation readings, making policymakers less confident on what to do with interest rates. A new incoming administration also implies caution to understand any changes to the policy trajectory, which is, of course, going to fuel growing support for a pause in interest rate cuts in the not too distant future. Markets presently are pricing an 86% chance that the central bank lowers interest rates by 25 basis points next week. We also get the factory gate inflation, that's the PPI, also this week ahead of the FOMC meeting. Today's data comes as President Joe Biden touts his administration's economic legacy during remarks at the Brookings Institution yesterday, arguing that the country is at a critical moment for the direction of the economy. Biden also said economists agree the new Trump administration is going to inherit a fairly strong economy, at least at the moment, and hopes that the new administration will preserve and build on this progress. Is a stiff regulatory environment a headwind to growth as Trump offers faster permits for companies investing $1 billion or higher? The answer is, of course, yes and no. Many see the past sense of balance as somewhat restrictive, but regulators also see today's entrepreneurs as more aggressive and predatory, requiring a more assertive regulatory stance. Environmental protections are important, but can indeed go too far in delaying projects with positive impact on not just the economy and jobs, but to move the society forward in terms of well-being of citizens. The big issue for people now is inflation. No doubt, increasing supply of goods as investment flows come in will help, and lower costs of entry can be passed on to consumers. Faster process of capital inflows can also help bring down inflation as competition pulls down prices. But there is a cost to relaxing regulation, as we have seen in the financial services area. Sectors like cryptocurrency and alternative disruptive models have been proven to require adequate guardrails to protect consumers. Others argue that the incidence of bad players may have been exaggerated. My sense is that we get these swings of overregulation and underregulation, and also regulators in a fast-moving, technology-driven arena tend to play catch-up and need more push rather than be slowed down. But given the broadly tepid global economy, especially in developed environments, you will need some sort of catalyst to unleash all the potential in AI and new digital technologies and robotics, and of course cheaper energy from improved supply cannot hurt. The argument is that production of more oil in stricter regulated environments will still be much cleaner and environmentally sensitive than in most OPEC Plus countries, even with a lighter regulatory touch. The good news is that business environments have a way of adjusting, and over time we could get needed corrections if regulations are over-relaxed. For now, details on exactly how the US business environment will become more relaxed are sparse, and a lot, of course, will have to do with execution. OPEC, in its just released December report, commented that Chinese stimulus measures and sustained growth momentum in India is supporting global economic growth, which for 2024 is projected as 3.1%, adding that the robust economic growth dynamic is expected to extend into 2025 with a milder forecast of 3.0%. They therefore see a global oil demand in 2025 rising by a healthy 1.4 million barrels per day year on year. OECD oil demand is expected to increase by 0.1 million barrels per day, mainly from the Americas. In the non-OECD, a 1.3 million barrels per day year-on-year increase is projected, with China and other Asia driving the growth, supported by India, the Middle East, and Latin America. OPEC's demand forecast was based on assumed sustained economic and petrochemical activity, which supports demand for transportation fuels and distillates in 2025. On the supply side, in 2025, non-OPEC plus liquid supply is forecast to expand by 1.1 million barrels per day year-on-year. The US is again projected to lead growth, accounting for about 45% of the total, followed by Brazil, Canada, and Norway. Today, crude is up, Brent standard over 1.0%, driven by geopolitical uncertainty. But going into 2025, according to the OPEC report, hedge funds and money managers still maintain their bearish stance on oil prices. Nigerians are getting a taste of reform, and though at early stages it has been a tough sell to stakeholders. In concluding our clip by Tola, Adeyemi CEO, KPMG West Africa, he speaks on the role of CEOs, especially in the African context, to position, to influence government and support towards building capacity so that they can implement comprehensive changes that will enhance the business environment. There is a win-win here, and the smarter CEOs will have found a way to discover it. Let's hear Tola Adeyemi telling us more on the latest KPMG CEO survey.
There was another message that came from speaking to CEOs, and this was around the evolving role of the CEO, especially within an African context. And the message here was that in Africa, more so perhaps than in other parts of the world, the role and influence of government on the business environment cannot be ignored. Government's role is to provide the enabling business environment. But sadly, in Africa, the feedback we get is that many governments are failing to do this. And hence, CEOs are finding that they need to be at the forefront of engaging with government to explain the issues that business is going through, and then working with government in coming up with the solutions, and in many instances having to lead the way in terms of the implementation of those solutions. So within an African context, there's clearly a need for CEOs to be, in a sense, the chief spokespersons for their organizations. Some would argue the chief lobbyists of their organizations in terms of influencing government to create the right business environment. So in conclusion, arising from this survey, we see our view is that quite clearly those businesses that will create sustainable long-term value are the businesses that come up with bold strategies and make the right investments in technology, in talent, and in ESG. Thank you.
Asia-Pacific markets were mixed after major Wall Street benchmarks fell ahead of key U.S. inflation data. China indexes are higher after Beijing commenced its annual economic work conference to outline its economic policies and growth targets for 2025. In European markets, we see the indexes edging somewhat lower at the open as traders brace for tomorrow's interest rate decision from the European Central Bank. U.S. futures were, however, higher after the November inflation in the U.S. came in as expected. Well, that's all we have on this episode of Global Business Insights. This is Bode Oshosami. Thanks for sharing on Facebook, LinkedIn, X, and YouTube. And again, thank you so very much for watching. Bye-bye.